Good morning, everybody. Hey, welcome to the end of the first week of June. I hope that your month of June is off to a great start. The markets, well, they were a little shaky yesterday. We'll talk about that and more when we get on the phone with Dave here in just a minute. But before we do that, let me just remind you that there's only one thing that any of us can control within our portfolio, and that's how much risk do you have? Do you know what your risk number is? And does your portfolio line up with that risk number? That's why we developed the financial x-ray. Give us a call at 863-382-0037 to schedule your no obligation financial x-ray. Hey, with that, we're going to start off this Friday with Dave here. And good morning, Dave.
05 point Light FM. The fray is there. How to save a life. Speaking of the fray, let's see what the fray's like up on Wall Street. Check in on your money and find out how the investors in New York are treating your IRA this morning. We have himself on the line with an expert view as well. Phillip Statler from Statler Financial Services is here as always. Phillip, how are you this morning?
Good morning, Dave. Hey, doing well as we close out this first week of June. Yesterday was a bit of a disappointment, though. We ended up all the way in red across the board. The Dow, not too bad, but the other two indexes, especially NASDAQ, kind of took it on the chin yesterday.
Yeah, NASDAQ kind of got its butt kicked. It was down by 142 points yesterday. That was a full percent. Dow was, as you said, just kind of a kiss in your sister day. It was 0.07%, down 23. And the S&P was kind of in the middle, down 15, but that's a full third of a percent. Got to be still kind of what I was suggesting yesterday morning, just worries about whether or not the Federal Reserve is going to tighten up on the money supply, cut back on the bond buying, and basically take the market off heroin. And that's got us into kind of a funk at the moment, doesn't it?
Yeah, it does. You know, we've got some macro stuff coming out today, and that's been some positive news at the beginning, but then it kind of waned a little bit. And you know, it's interesting to see what the different Fed guys are saying when it comes to taking us off of crack, as you say, and quit playing with the interest rates. But you know, that's still probably down the road before we see any of that start to really take place.
And we got a little bit of reassurance on that yesterday because one of the Fed governors was doing the rubber chicken circuit, and he told his audience that don't worry about it. There's nothing really that close on the horizon that's going to make us stop our bond buying and interest rate binge and whatnot. That gave people a little bit of assurance anyway. But one Fed governor that I don't even know if he's on the open market committee or not, but that doesn't exactly give us assurance that they aren't going to do anything. One thing that might give us assurance they're not going to do anything is a crappy unemployment rate report. And while the rate looked good, the Fed says this morning that we created 559,000 jobs last month. Oh, goody, because I had numbers ranging from 650 to 671 expected. So that's El Stinko.
Well, yeah, that's definitely a miss. But, David, got to say, it's much better than what the May number was or what the April number was, because that was like 278. I know they revised it up a little bit, but still not enough to really make a difference from that standpoint. But to still, you know, we're heading in the right direction. We are creating more jobs. And we saw yesterday that, you know, first-time claims were kind of heading the right direction, too.
Yeah, which kind of gives the picture that the investors that are concerned about the Federal Reserve probably are looking for. We're moving in the right direction, but we're not moving so fast as to encourage the Fed to start clamping down.
Well, that's true. Like we talked about yesterday, real estate may be the driving force between the whole world central banks in terms of what really causes interest rates to start to move upward.
You mentioned that yesterday. Yeah, the boom in housing prices might be very well the thing that could prompt the Fed to say, we're going a little fast, baby. Let's bump the interest rates up.
Exactly. So, but, you know, who knows? I mean, we still got a lot of different world banks and a lot of different Fed type things out there that are going to make those decisions as we continue. And the numbers right now, because they're a mixed bag, aren't really giving them much to work with.
Absolutely. And it also helps to recognize, too, our Federal Reserve does not work in a total vacuum. I mean, they're independent. They can do whatever they darn well please. But if you go off on a limb that's way in the opposite direction of what the Euros or the Asian banks are doing, you're also taking a chance on your own economy, and they kind of follow each other to a certain extent as well. The other parts of the government data dump this morning is drawing the picture. We were saying that it was a mixed bag. We were disappointing in job creation, but we were pleasantly surprised on unemployment claims. The unemployment rate, the thing that's going to show up in the top of the hour news on the radio all day, a pleasant surprise. It was expected to be 5.9%. Our official unemployment rate for the report this morning, 5.8%. Once again, comes to the notion reinforcing that we are going in the right direction.
That's right. And it's better than the May number. The April number was 6.1%. So that's a lot better. And remember, I think we forget this a lot of times, especially when all that we've gone through, but full employment is when we get an unemployment rate at 5% or better. And so we're really getting close to that day, which is in some ways a little concerning.
We start bumping down below 5%, then we start looking at the Federal Reserve one more time. And you also have to kind of look at it from the standpoint of everything being relative. Canada also reporting their unemployment rate today. And we mentioned this to each other before we went on the air that, they're still locked down more than we are. But we got a 5.8% unemployment rate. Canada's is still over 8%. So everything being relative in this part of the world, we're not really doing all that bad.
No, we're really not. And that was the point. But we're really between 5 and 6% is not a bad place for our unemployment rate to lay.
Yes, given what we're going through, you're absolutely right. So we've got a pretty full color picture of the economy from the unemployment standpoint from the last week. Earnings season, we're kind of on the tail end, but I know we got a couple of reports that came out from companies that are bellwethers.
We did. We got some household names that people use all the time. One of them's Docusign. That's a big deal if you're doing a mortgage or opening up a new bank account or anything like that. Docusign is probably one of the mainstays in that electronic signature industry. And they had a good quarter. They beat by 16 cents a share, came in at 44 cents a share, revenue ahead of expectations, and they gave an upbeat outlook. So things are good there as more and more companies adopt their technology, and they're getting a big bump today, up 6.7%.
Wow. I think that's one of those lines of work, one of those industries that catch my eye is that kind of got a foothold and probably isn't going to give it up. They got the foothold during the pandemic when nobody wanted to look at each other face to face, and all of a sudden everybody discovered, by gosh, this is convenient.
Well, that's true. That's where they really made their gains, Dave. But Docusign was probably the premier company to use even prior to that, as more and more companies went to some digital signatures. But obviously, COVID just really, catapulted them up in that industry.
Oh yeah, when I refinanced my home 3 years ago, and I did the entire doggone thing without looking a person in the eye. It was all off a Docusign.
Yeah. Then we have a couple, I guess you'd say retail or producers. We got Five Below, which is the discount retailer where everything in the store is $5 or less, not 5 degrees or less. So, when I first saw that, I thought, well, geez, that's going to be cold to go in there.
Clarify, please.
So they had a good quarter. Revenue beat. EPS beat, so they said their comparable same store sales, you'll like this, up 162%.
Wow!
Compared to the same quarter a year ago.
We don't even have one of those here in town, do we?
No, we don't. We do not.
No.
And they're trading up 6% this morning as well. The other one we had is Lululemon, and the athletic wear producer. They beat also. They came in at $1.16 a share compared to the 91 cents they were expected. Revenue ahead of forecast. They've been benefiting from both people going to physical locations now, as well as e-commerce. So they're getting it on both ends, and they gave an upbeat forecast for the current quarter. Not quite as well as the other two companies we talked about, but still up about 0.8% this morning.
We're happy to take anything with a positive move. I got a tidbit on one of the companies we talked about a lot. We mentioned this before we went on the air. Facebook announced today that they're considering a change in policy, putting their moderation requirements, in other words, how well you behave on Facebook, applying that to politicians as well. You and I both kind of said it's about darn time, right?
That's right. As long as they're fair about it. And that's the only thing that their opinion may not be the opinion of everybody else. So, I
Yeah.
got two more for you that are kind of interesting. We got Broadcom. We talk about chips, the chip industry and the issues they're having. Well, Broadcom is a maker of computer chips. They beat by 19 cents a share, came in at a quarterly profit of $6.62 a share. Revenue, not killing it, but just a little bit above what everybody had forecasted. And they gave a better than expected outlook for the coming quarter, which was good. And they're really into helping the ongoing adoption of that 5G technology that everybody talks about. So that's a good thing for them. They're up about 0.25%. They're a pretty expensive stock. Right now, it's about $466 a share.
Any chip maker that has positive guidance, I'm happy to hear about.
Exactly. Hey, the last one I have for you, and this one's a little interesting. It's called Chargepoint. Chargepoint is a company that has developed or is developing a charging network for electric vehicles. Yep. And so they had a wider than expected loss for the last quarter, but they had better revenue than expected, and they held to their 2021 revenue outlook. So you would think that they'd be getting hammered today, but they're not. They're up 4.1% this morning.
I guess we can forgive a company once in a while for an off quarter, if everything else is together, right?
That's right. That's right.
Resetting the table for the morning off day yesterday, not by a ton, except with NASDAQ. They had a rotten day. 45 minutes before we open up this morning, what are we looking at?
We're looking at a lot of green today, Dave, and that's good because when I first started watching this morning about 5 o'clock, we were pretty much in the red. We got the Dow right now up 0.25%. That's $82. The S&P 500 up about 0.4% or $16, and the Nasdaq's up, getting close to 0.5% now. So good numbers there. And even on the commodities front, we've got silver's up 1%, still down at 27.75. Gold is about 0.7 up, and then the crude oil, the one we don't want to be going up, is up about 0.6% to $69.25 a barrel right now.
Oh, poop. I was reading earlier. That's mostly on expectations of increased demand as the economy recovers, which you kind of say, oh, boy, it's going up for the reason we want to see it go up, but just not so doggone fast, please.
Yeah, and I was kind of amazed yesterday when I was going home, Dave, that gas prices by my local gas station were down 4 cents yesterday.
That's intriguing.
Yeah.
Maybe it's just in the pipeline.
Maybe it is. Maybe it's not there yet.
That's it. World markets really don't have much of a direction. Asian rim mostly up by a tinch at the close this morning, very early on. Europe is going nowhere. We're talking about hundredths of a percent one way or the other with a zero sign halfway through their day. It's a weekend ahead, Phillip. Time to look down, look at your retirement accounts. And if you aren't sure where they're going, a third eye looking at them with an unbiased view might be exactly what's in order. How do I enlist your help to do that?
Absolutely, Dave. And give us a call at 863-382-0037. Then go to our website at statlerfinancial.com. There's a link right there to our calendar. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 7:30.
And back here on Light FM Monday morning about the same time. Phillip, thank you so much. We'll see you on Monday.
All right, man. You have a great weekend. Hit that golf ball nice and straight, and we'll talk to you on Monday.
Thank you, my friend. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, folks, again, I want to thank you for joining us this week. I hope that your June is off to a great start, and I am looking forward to a great weekend. I hope you are too. I look forward to speaking to you again on Monday. Until then, so long.